Okay, everybody, grab a seat. We're going to go ahead and kick off here in about, well, it's 2:10. We're going to kick off right now. So thanks for being here. We have a really interesting panel today to talk about alternative ways to fund your startup. So we just heard from a bunch of venture capitalists. We heard about some of the challenges of getting their attention, but there's other ways to fund a growing business other than venture capital. We're going to explore that on today's panel. I'm going to do a quick introduction of the panelists. You all should have downloaded the app. There's detailed bios in there, so I'm not going to spend too much time, but just so you have a sense of the expertise we have here on the panel. So first we have Raz. Raz is the managing partner of Aldridge Capital, which is a growth equity firm with offices in the Bay Area and Washington, D.C. Aldridge focuses on investing in bootstrapped, profitable entrepreneur-run companies in software and the HCIT sectors in North America. Raz has been on both sides of the table, both as a software founder, CEO, and a private equity investor. So it'll be great to get some of the insights from sort of both raising money and also investing money as well into alternative, different ways of funding the businesses. We also are really fortunate to have Delilah Penio with us. Delilah is the Vice President of U.S. Capital Formation for the Toronto Stock Exchange and the TSX Venture Exchange. She advises U.S. companies on the potential to raise capital in the Canadian public markets, specifically targeting high-growth U.S. companies raising Series B plus capital and looking for an alternative to private venture capital on their path to the NASDAQ. Thank you, Delilah. We also have with us Michael Bowden. Michael is the president of private equity at Mark IV Capital, where his team oversees both the venture capital and private equity portfolios as well as other asset classes. And then finally, we have James Cross. James is the co-head of private investing at Franklin Venture Partners, Franklin Templeton's flagship U.S. equity group for a little over 25 years. Franklin manages around $4 billion of growth equity investments under the Franklin Templeton, a top 10 global asset manager based in Silicon Valley. So as you can see, we've got a really varied panel who can give us some really good insights. I want to kick this off. I think there's been a lot of attention in the press, obviously at the end of 2024 going into 2025, about the state of the IPO markets, both in 2024 and some predictions for 2025. And of course, the IPO market is an alternative way to raise funding, even for early stage companies when it's hot and when it's open. So I want to get some insights from Delilah maybe about what did we see in 2024 and what are the thoughts about what we're going to expect to see in 2025?
Okay, who has their crystal ball ready? So I just want to set the stage for what happened from 2021 to 2022 to 2024, because that really has impacted all the capital markets, public, private, debt, from when we went through from the IPO market here in the US in 2021, from 485 companies raised $142 billion, down to the next year where there was only $8 billion raised by very few companies. So that drop, we've never seen that before. And the comeback has been very, very slow. So everybody here who's been in any remotely touching any part of raising capital, whether it's early stage, venture capital, private equity, debt, venture debt, public markets, it's been a really rough 3 years. I think we can all agree to that. And what has happened, because the IPO market drives the exits, right? So all those VC funds and private equity companies that would have exited their companies in the last 3 years didn't. So those LPs didn't get their money back. So there's not been new money putting back into the market. So that is really what has caused this stagnancy of the markets for the last 3 years. And 2024 was a little bit more coming to life, but still very challenging. Now, the last quarter of last year definitely was significantly different. And so we started to see all the markets, Canada, US markets start to come back, some IPOs start to get done, and we're all now waiting. So here we are in 2025. So in theory, market can't sit as long as it's been sitting. It has to move. And so there's a massive backlog of really great companies that would have listed, done an IPO in the last 3 years, but didn't. So now you're going to see competition for who's going to be able to come to market. Now, we don't know with the new administration coming in next year, next week. So we're all very obviously looking at what's going to happen. In theory, it's going to be very positively impacted, but it's still very uncertain. And we're in an unprecedented time globally. and everything that's happening with interest rates, et cetera, it's still not certain as to what's going to happen this year. But we have definitely seen some good traction start to happen with companies starting to raise capital. In Canada, we have a concept called bought deal, where the investment bankers will guarantee the money is going to be there. And so we're starting to see that happen. So our current companies are raising capital. So there's very good signs of life coming. And so, but I think these next 6 months, especially the first 6 months of the new administration, is going to really impact what's going to happen in the markets and how comfortable investors are going to be coming back into the market. And I'll just say one other trend that happened that we obviously track very carefully. So all that risk capital, especially in Canada, where you can go public at a very early stage, even pre-revenue on TSX Venture Exchange, that risk capital that was in the markets financing those early stage companies, a lot of it moved to ETFs. So, and a lot of it moved to cryptocurrency, but definitely risk capital generally moved to our ETF business is through the roof. We've never had so many ETFs. So the question is, now that the markets are turning, coming back, will that money, that risk capital, come out of ETFs and back into early stage financings? And that's what we're obviously hopeful for, but we don't know.
So, there are times when the IPO market is really open for really early stage companies. We saw that in the, post pandemic, right, with the SPAC boom, right? So what do you think it's going to take for that to happen again, for really early stage companies to be able to list? Because clearly they haven't been for the last certainly 2-3 years.
Yeah, well, it's going to be the combination of all that. So what's happening politically, what's happening in the world, the interest rates coming down, being able to leverage, debt and the equity markets, or certainly, venture debt you can't get without venture capital, right? So all of that is impacted. But certainly the trends, like again, that we're seeing is that investors are starting to want to move their money again, right? And so when they do, where does that money go? So obviously there's always the momentum plays of the time, where obviously AI is going to be the biggest one. But again, most investors are going to look for, like, again, if you have a backlog of really great companies that didn't go public, that are real companies, real revenue, even profitability. So investors are going to choose those companies. Makes sense if that's what your choices are. And there's going to be a lot of AI stuff. There's always a momentum play, especially in the junior market. There are investors who want to be VCs, right? They want to get in those early, Series A, Series B rounds in the public markets. And so definitely look for those. But there's going to be a lot more. I think some of that was on the panel earlier, just around the fundamentals of real companies, real revenue, real traction, real growth, because there's a lot of those companies out there.
Okay, so before we move off of that, so basically what you're saying is these mature companies that have been funded by VCs, they have big valuations, all these unicorns out there, we're probably going to see those go first. That creates sort of an open IPO market, and then maybe later it starts to open up again for maybe earlier stage companies.
Well, and just also ones that survived, right? I mean, if you raised a lot of money in 2021 and you were smart enough to be capital efficient because there wasn't a lot of money to go back to. So investors are definitely looking in public markets, private market, like who survived the last 3 years, who was resilient, who was cash efficient, like who pivoted, who well, really just who's still here, right? And so that I think is going to be, those companies are going to get, those stories are going to be known.
Excellent. Okay, so that's an option, although it sounds like it might be ways off before the really early stage companies can access that. But
well, I would say that early stage companies, both in the U.S. and in Canada, that there is going to be growth capital available to them, because again, those hot sectors, people want to get in on them. So I would say across the board, but again, smaller but still with revenue.
right, so I always hate to make predictions, but I do think we're going to see some very early stage AI companies
For sure.
some point in 2025. I think the bankers and the VCs are all sort of lining everything up to start moving those companies. So it'll be fun to watch and see how that plays out.
For sure.
Switching gears, Michael, maybe you can talk a little bit about angel financing for us and why that's a good option versus venture capital, and also help people how to access that in this kind of difficult market.
Yeah, I'd say, both angel investing and family office investing is very hard to find. There's not lists, they're not printed. I always tell entrepreneurs, maybe start first with some leaders in your industry that have had some exits and ask them both for advice, but ask them, who else they know may invest in this kind of stuff. The main difference too is for high net worths and family office capital, we have to live with the results. It's much more emotional money. And that can be both positive and negative. They can be more steadfast investors if they really strongly believe in your cause, help cross through that chasm and the valley of death in a lot of the growth and equity world. But on the other hand, they need to see the results and they need to have this recycled capital. And while Delilah pointed out accurately the IPO, I think the second half of that was lack of M&A activity. We've seen just a real dearth, whether it was in the biotech world with not a single transaction over $10 billion happening for the last, 3 or 4 years? So
We just had one, just got
had one,
announced.
the first one.
Intracellular, almost $15 billion.
Yeah, it's interesting. The day Linda Kahn put out her article about leaving the office, they had the first announcement. Coincidence. But, going back, so biotech's been, hard to have that recycled capital because M&A really drives that market heavily. We're seeing that across the board in all sorts of deep tech areas as well. So I think as capital starts to come in, it can be recycled and reallocated back because as groups that have to live with those results, we have to be really prudent about the allocations and much more willing to recycle, but also less willing to just allocate additional capital when that recycling is not occurring.
So let's take the two areas you mentioned kind of separately. Let's start with angels and then let's move to family offices because I think it's a little different. So if you were advising someone in the audience now, they come to you and say, hey, look, I want to try to find angels for my company. What would you tell them to do to locate angels that are the right fit for their company?
Yeah, the first thing I would say is look for luminaries in your industry and try to contact them. Like I said, start off asking with advice and where else do they invest. The other one is there's some great organizations like here in Southern California. There's was it Tech Coast Angels. There's another great angel group in the Bay Area. There's Desert Angels out in Arizona. So there's many organizations to kind of reach out to, and they go through pitches and will help refine as well. Also, people like Expert Dojo, they're going to have a great list as they go through their incubator. And a lot of times these incubators, one of their key values is identifying investors in the space.
So I think one of the things, you said sort of the luminaries of the industry, which I think is important for people to really focus on. Basically, you want to really find people that already know this space, it's because sometimes a lot of companies sort of just shoot very broadly to find angels. Oh, they'll reach out to lots of people and say, oh, can I, find me an angel investor? But the reality is, right, that's like herding cats, right? So instead, what I hear you saying is focus on people who already have kind of made money in this industry because they know it and they're more likely to write a check.
Exactly.
Okay. Now, what about family offices? Because again, those are, VCs. Someone calls me, or a lawyer, or the accountants. We know the VCs, right? Family offices are a little more opaque, right? They're not sort of as public. How do you find family offices to invest in your business?
Yeah, the hard part is a lot of them are opaque on purpose. They're there a lot of times for the anonymity of a family. But if I think about the one common thread in every single family office is they usually started with an entrepreneur. They've usually started a company, exited, whether they're IPO'd or other means, and were able to build that first generation wealth. Now, how many generations it's gone is another factor in it as well. But I'd say it's hard to just go cold solicit, and some family offices will have a focus. And so, again, going back to understanding your industry, there's one I can think of in Newport Beach right now. It was a very successful software SaaS entrepreneur, created their own family office after a sizable exit. The only transactions they're ever going to do are very industry similar to what he was in before.
Okay, so again, that's interesting. So family offices, same kind of idea. Look for people who made money in the space that you're in, and then do some research to find those family offices. Is there any, like you mentioned some like resources, like Tech Coast Angels and things like that. Are there any things like that for family offices where you can actually get like lists of family offices or their backgrounds, a place to find them?
There haven't really been. I think there's been some concerted efforts a few times to try to pull together, especially again around certain industries. I think Trusted Capital was one really focused on the DoD and defense, but there really hasn't been a good convening force. I joke often that once
Sounds like an opportunity for somebody to pull that together and maybe publish it.
I joke often once you've seen one family office, you've seen exactly one family office. They just operate differently, different investment committees, theories, processes. So
Sure. Before we jump off family offices, just real quick, will they lead an investment, family offices in your experience, or are they going to be looking for a VC to already be in the deal?
I think that also just varies very widely. For instance, in our group, we will lead one or two a year. It'll be very, very specific and niche. We're going to really look for a lot of our VC counterparts to be part of that round as well. But there are other family offices that will lead every transaction. So I think of like Pritzker Group, for instance. I mean, they acted and worked like every other VC and were very strong lead investors and had a great group of people around to co-invest. So it's all about how can they build that syndicate.
Okay, great. All right. Well, switching to a different market, sort of maybe a bit little later stage, and Raz and James, maybe you guys can talk to this both about, when is it appropriate for a company to be actually approaching private equity growth capital as opposed to the earlier stage we've been talking about here?
So maybe define growth equity first, and in particular, traditional growth equity. Growth capital firms tend to invest in firms, in companies that are profitable and growing and don't need money, which sounds like a little bit of an oxymoron. But these are companies that have been bootstrapped. Maybe they've raised a little bit of angel financing. Because of the limited capital resources these companies have had, they've had to get to profitability and cash flow a lot faster. There's a close ownership, so it could be family owned, can be owned by a small set of shareholders, potentially with some outside angel investors. And what happens is that these companies are growing, and the rate of growth can be anything from 15% to 30, 40%. But that rate of growth is typically capped because the only resources you have to fund, whether it's additional product investment, sales, marketing spend, is just what's on your balance sheet. And so you're typically capital constrained. I would say there's over 100,000 of these companies in North America. A lot of them are services businesses. And a lot of these companies, which are closely held, they don't really want to get outside capital. The entrepreneurs really value having complete control over their businesses. At some point, these companies also become a lifestyle type of companies. But there are a small number of them where the entrepreneur realizes he or she or they have the ability to potentially grow this into a much larger company if they had capital. And in addition to the capital, what they really are looking for is know-how. Because as an entrepreneur that has built a company, and most of these companies, by the way, they're not in the venture capital hotbeds, because if they were there, they would have raised venture capital. So they're in San Diego. We have an investment here in San Diego. They're in Albuquerque. They're in upstate New York. They're in Tampa Bay. They're in Denver. And so there comes a point where that team, the entrepreneurs, the owners of business, have to make a choice. Do they continue to grow at that 15, 20% rate and own 100% of their business? Or do they try and find a partner who, in addition to capital, more importantly, brings resources and know-how where they can grow their business at a much faster rate? And instead of trundling along at 10, 15, 20 million revenue, they have a real shot at being $100 to $200 million revenue business. And that's where growth equity plays, is that they look for companies that have proven out some data points. The data points being, the product market fit, but validation around customer ROI, being able to identify what the focus is for this business, size the market. And it's at that point where the entrepreneurs have to make a choice, right? Is that, do they give up part of their company? So in return for having these resources, they sell a portion of the business to an external growth equity firm? Or do they continue owning 100% of a company, which potentially could, be a much smaller business than it has the potential to be? So that's where growth equity plays, is for founder-run companies that are profitable, growing, and have proven out their business model.
Excellent. James, so you invest in some of these companies as well at that stage. So what is it that you're looking for when you're trying to see if this is a good company for you to be investing in?
Sure, we're a little bit different of a flavor of growth equity from Roz. I work at a mutual fund, so I'm looking at these companies from the public side, from the publicly traded side, back over that IPO line, and trying to figure out which of them have the momentum and are on a good trajectory and can be great publicly traded companies that we can own, hopefully for decades. We're very long-term oriented shareholders. So I'm looking for our next multi-decade holding before they go public. Just our profile, not every growth investor has a slightly different strategy. We're looking for about 200 million in recurring revenue in a company that will be ready to go public in 2 to 3 years or less. So that's a pretty small universe, and our challenge is accessing these companies, much less than identifying them. It's not that hard to know who are the top 50 private companies. You can go on PitchBook, run a list in about 5 minutes, and you know who your investable universe is. So getting access to a Stripe or an Anduril or a Databricks or a SpaceX or a Canva, that's our challenge. So we spend a lot of time building relationships with these management teams and building our position over time. And we're indifferent between buying on the primary or the secondary market. So that's sort of a pretty narrow universe. Our challenge today is everybody knows the household names I just listed off. What we're trying to think about is, well, who's next? I mean, who's the top 26 through 50 who may be a year or two early for when we would get involved, but we want to go ahead and start building relationships and figure that out. So it gets a little murkier as you start looking 3 to 5 years down the road. And I know there's a lot of ways to analyze the IPO market. If I have two observations. If I simplified it, thinking purely traditional venture style IPOs, historically there's only been about 25 a year. And I think right now we're sitting on about 1,000 unicorns in the private world. So that math is pretty bad. We'll see how that goes. I think a lot of them end up being really good private equity acquisitions for their software recurring revenue, but at much lower multiples than they would like to sell out at. I think the idea that the IPO market is closed it's obviously it appears that way on the surface, but since I work in a mutual fund complex, we manage $200 or $300 billion of U.S. equity on the public side. We are the buyer of those IPOs. I can tell you the demand is there. We just didn't want to pay the prices that all these entrepreneurs wanted from when they raised money at absorbent valuations in 21. But if you think about it, out of the Fortune 500, there's the S&P 500, there's 7 stocks that are driving most of the market returns. The Mag 7, it used to be the FANG, but we had to throw a couple more in there. So now we have the Mag 7. I can tell you that the SEC limits the ability of a mutual fund manager to have a position size large enough to buy the Mag 7 because it makes up 40% of the index, and we're capped at like 5% for each position. So the public markets are desperate for new ways to play all these emerging technology trends like generative AI because we can only buy so much NVIDIA in our mutual funds. So I think there's some confluence of currents here, and if I were to make a bet, I think the next surprise in the IPO market is that it accelerates more sharply because the base case today is perpetual, infinite delays, and no one ever wants to go public again. So hopefully we get some policy help. I mean, the last administration was sort of indifferent to the going public thing, and they were hostile towards M&A. So hopefully we can at least get the neutral on M&A and a little more hospitable on IPOs.
Great. So if I understand this, it sounds like, Raz, like you fund companies and then James comes along later and provides more funding as these companies are growing. Is that fair? Do you look to James to fund these companies as you sort of done the recap and then take it to the next stage?
Funding about typically James and folks in industry are an exit path for us. So you could think of the whole funding continuum here to some extent, right? You got angel funders, then you can have VCs, growth capital, and then a lot of growth capital backed companies end up either selling to larger private equity firms or they can exit via a public listing as well.
So, go ahead. Yeah,
Let's chime in there. James mentioned something interesting too on secondaries, and we're starting to see some of these funds that we probably held for 10, 11, 12 years. So they're near end of life on those funds. They've done their 2 extensions, and they're starting to use secondaries more. And I think we're starting to see a lot more activity there as a way to monetize as well. Right.
Yeah, and I'd also just like to talk a bit more about public venture capital. So, I mean, because that's a very traditional spectrum of capital in the U.S. markets, although there is a lot of money raised in the earlier stage in public markets in the U.S. But in Canada, what's unique is we have this 2-tier market. So Toronto Stock Exchange for larger, revenue generating stable businesses, but TSX Venture Exchange, uniquely in the world, is a public venture marketplace. And so the sweet spot of capital raises in that 5 to 20 million raise. So this is truly like Series A, Series B, depending on the timing in the, in the sector, what the letters mean. But so really early stage, and it's a true alternative to private venture capital. So the biggest question, obviously, I'm sitting here in San Diego working for Canadian exchanges. Why in the world would any US CEO need to go to Canada for money? That seems nonsense. We're in the largest capital market in the world. And it's just because the US capital markets are not conducive to small public companies. They used to be back in the day when, companies did $50, $100 million IPOs and were able to grow and be successful. And as retail investors, we got to participate in those. But that, that ship has sailed for a long time in the US. But in Canada, that's still true. So you can, and a lot of US CEOs, why they talk to me is that they don't want to play the venture capital game. It's not that the public market game is easier, it's just a different game, right? So it's just for any founder in the room as you're thinking about your growth trajectory, because whatever you raise today is going to impact your ability to raise your next round of capital, is know all of your options and then make the most educated decision on what's right for you, for why you're building your company, the kind of company you're building, the kind of capital you're going to need over the next 5 years, and then make those decisions. So venture capital has a very important role in the markets, and then so do the public markets. So again, uniquely TSX Venture Exchange, you can list at an earlier stage, and that market's coming back again now. So if you're raising that, 5, 10, 20 million, there is an opportunity, and we're truly a stepping stone to eventually dual list onto NASDAQ. So you'd start on the venture exchange, graduate to TSX, and then dual list onto NASDAQ. And that's a well-worn path. We have 150 companies that are US companies already listed. So again, just thinking about, we all have to be thinking about different capital options because they're not all available or attractive, right? I mean, people think about, is this actually the desirable route of capital that you want to go? So just be educated on it, and then make the right decision.
Okay, so we've touched on a bunch of different areas. One area we haven't touched on yet is getting money from strategic investors. So James, maybe you could talk a little bit about, why would a company look for strategics, and in particular, maybe focus a little bit on, what are the risks of bringing in strategics? We all know the benefits, right? You get cash, you get relationships. But what are the risks when people bring strategics onto their cap table?
Sure. So on our growth equity platform, of the $5 billion, 10 or 20% of it comes from one specific strategy where we have corporate LPs. So we built this, I hate to say program, but partnership where we call them strategic limited partners, and we act as their eyes and ears in Silicon Valley, help them move along on their journey in engaging in the emerging technology community, discovering what their role is, how it may threaten them, how it might benefit them, how they want to partner with it. So we can help a corporate get from 0 to 60 in venture, and then it's sort of up to them. Do they want to get to 100 or 150 miles an hour, or are they going to drive the car into the ditch? And we've kind of seen it all. I think we have 8 or 9 or 10 companies, publicly traded companies like a Raytheon, AeroVironment, Ralph Lauren, Allegiant Airlines, etc. So a lot of experience doing that over the last 6 or 7 or 8 years. I think if you'll allow me to simplify, generally I think corporate or strategic investors are very useful for hard tech or industrial tech or non-software. I think on the software side, it's a completely different dynamic of new entrant versus incumbent. Whereas in the industrial world, the new entrants are not ripping out all these high capex installed bases overnight, whereas in software you can. So that's an oversimplification, but I think it's a good starting point. So in the hard tech world, there are a ton of benefits of having strategic investors. Since you asked me to unpitch my own pitch, I'll do my best without offending any of my corporate LPs. One issue is just the branding of the cap table itself. So there are a lot of investors who perceive corporate capital as somewhat inferior. So it may potentially hurt you from capturing tier 1 capital down on Sand Hill Road if you've got a cap table cluttered with corporate investors. I personally don't believe that, especially in the hardware side. But that is one perception. Another one is more on the operational side. If you let them on your board, there can be a lot of issues. One, you tend to have turnover in that seat. So you've spent a year or two building a relationship with a great board member. They get a new corporate job. They're gone. You got to break a new one in. Two, if you're in a high growth situation, a lot of cross currents in your industry, you need your board to be responsive and make rapid decisions. Some corporate VCs, CVCs for short, have lengthy committee approval processes, and the board member has to go talk to the CFO or the investment committee or the GC, and they're busy, and so it slows down decision making. Third one might be if you have a corporate lead around, it may be priced inappropriately, too cheaply, too pricey, whatever. I think there are appropriate moments for corporates to lead rounds, and that's one of the things we do with our corporate LP partners is help them, especially their first couple, figure that out, hold their hand with the management team, the founders, the board, etc., and look for those situations where it does make sense. For example, we sat down with Impulse Space in LA. It's a startup run by Tom Mueller. He was the first employee at SpaceX, and we brought Raytheon in with us and had a great set of conversations. We had known the management team. This was a very competitive deal. Folks like Andreessen and Founders Funds and others were involved, and we helped Raytheon end up actually leading that A round. So Tom is trying to build the SpaceX of space, which is like Elon will get you out to space. Tom will get you like towards the moon or
Well,
somewhere
not on
else.
the most recent launch, you won't.
Yeah, the reason a little rough one. Anyway, so hopefully that's a few examples. I think there's pros and cons. I think in our area of focus with our defense industrial tech strategy, I think it mostly shakes out to the cons or the pros. I mean, sorry.
So Raz, when you see a strategic, maybe one or even a few on the cap table of a company, do you view that as a positive or a negative, and why?
A lot of the time when we see a strategic and cap table can create some complexity. The most common scenario we see a strategic is when they're also a customer, and they've decided to support their vendor with providing some capital. For us, we have a neutral point of view around that. We do look at what terms and board rights and governance a strategic has, and what you'll find is most growth equity firms like to kind of clean up the cap table, and what we'll try and do is buy out that strategic investor while maintaining the customer relationship. And a lot of the times for most strategics, it's a small amount of money, particularly the companies we're dealing with can be 1 million, 3 million, 5 million, 10 million. We see it quite frequently in the life sciences space, where that strategic is going to be a big customer and they want to support the company. And unlike what you described in our world, they're not doing it for financial reasons. It's mainly to kind of cement a relationship.
And I think that's really important, that a lot of times these strategics are coming in because they're customers, and sort of the negative, whether it's in the biotech space where we see it even more often, but even on the tech space, very often there's sort of some belts and suspenders that come with that investment, a right of first refusal, or even sometimes an option to acquire the company, and that really shuts off the opportunity, right, for a firm like yours to come in. And so unless that can get removed, it's kind of like a showstopper, right?
Yeah, I think so. Look, I think the discussion that we're having, we're all taking a little bit of a capital-centric perspective, which may be the case for a lot of entrepreneurs, is that you'll take money from wherever you can get it. But if you do have the ability to select from different options, the dollar is the dollar. It's fungible. It's what are you looking for from that investor, right? Whether it's an angel, venture capital, strategic, family office. Are there a specific set of resources they can bring, some relationships, some know-how? And you can look at it actually in the venture capital ecosystem. You look at the backgrounds of the various partners that are at these firms. You'll find they have different areas of expertise. And so if you're fortunate enough to have some choices, what I would suggest is focus on the relationship you want with that firm or that individual and what can they do for you. I think for a lot of entrepreneurs, it's not that helpful if you just have passive capital. Right? The money just comes in and then you're like, okay, that's great, but how do I hire my head of engineering? Right? How do I structure this partnership? And that's where I think having investors that can bring more than just capital is particularly important.
Yeah, and that you named off some more of the cons. And that's one of the things we try to do with our corporate LPs is coach them through. It's actually not in your best interest to ask for a ROFR or exclusivity. It really hurts the growth prospects for the company. It really hurts their ability to raise capital in the future. And one of the mistakes we see a lot of times for new corporate entrants to the VC market is they use their M&A lawyers and their corp dev M&A team to execute these transactions, and they have no understanding about how high growth minority venture capital works. They're used to negotiating for the very best advantage in the deal across the board, and they're used to whole takeouts. So trying to talk them through why this might not be the best way to do things, that usually doesn't go too well until they make a bunch of mistakes and then they figure it out and hire real
Unfortunately,
VCs.
I think that's exactly right. I can tell you some horror stories of deals I've had where the strategic literally made us negotiate the entire exit M&A deal at the time of the investment, like as an attachment to the investment agreement. So talk about taking something that might cost X dollars and multiplying it by 10x. Exactly, exactly. So we've been talking a lot about like equity opportunities. We haven't really touched on debt opportunities yet. Um, I'll leave it to which of you wants to sort of grab this. I know most of you are more like later stage investing with debt, so maybe we could talk a little bit about that, and then we can maybe also revisit a little bit like where do early stage companies go, and is debt financing even available for them? Raz, do you want to maybe start with a little bit about debt financing? Because when you do your recaps, right? I'm assuming there's some debt financing coming in on these as well.
We as a firm, we don't. I know there are some firms that will use equity and debt to recapitalize a business. What I would say is over the last 3 years, debt has been very hard to come by, particularly for companies that are probably sub 100 million, maybe even sub 50 million. Silicon Valley Bank, which was in the venture ecosystem, the main provider of venture debt, has been subsumed. And they're still active in their current form. I'll give you an example of what the market's like now. We have a business that's about 30 million of revenue. It's growing about 60%. It's got 25% EBITDA margin, so it's getting close to 10 million of EBITDA, cash flow positive. They're just trying to get 1 to 2 million of debt from one of the venture banks I just mentioned. It's taken them 4.5 months, 6 meetings, and a whole bunch of paperwork to get the lenders comfortable. And that's a profitable, growing company. So I've got to imagine that in the venture world, it is still challenging. The model of venture debt is that they typically lend where the company just raised, $20 to $200 million of venture capital. Now, with rates coming down, then maybe there'll be a little bit more of risk on under the new administration. I'd hope that some more of the lenders start leaning forward and supporting some of the newer companies because, debt is an important capital source. It's non-dilutive. But you just got to be wary, again, as a small company to understand that there are kind of clauses and provisions that are attached to debt. It's less flexible. And so it can be cheaper than equity, but it also comes with its own form of constraints.
So I think there's a couple of really good points that you made, but I think one in particular is the availability of that debt. I think there's sometimes a bit of a misunderstanding among entrepreneurs that they can go get a loan from First Citizens, let's say, who took over for Silicon Valley Bank, but the reality is they're looking first to see that you've raised venture money. You have to have that equity. And if you don't have that, very often the loan is based upon the amount of the deposits that you have back at the bank. So net, you're not really netting cash. So it can be challenging.
And it can be a personal guarantee then as well. Right?
Yes,
a lot of small businesses, you may have to put up your house and a lot of your other assets. So you may want to speak to your spouse before you get into that arrangement.
Absolutely. Michael, do you want to talk a little bit about the companies that have used debt in your companies, and do you see that useful, or is it just not even worth pursuing in your experience?
Yeah, I'd say just sitting as a board member, you're exactly right. I think the fall of Silicon Valley Bank, we haven't seen WTI very active in the market. We saw some of these historical large players in the venture space really pull back over the last few years. And you're exactly right. We had a proposal from one of those banks for 90% of the loan to be held in a CD. wasn't really great. Or the other one was these international letters of credit. So to help buy chips overseas, a lot of times a supplier will require it. Same thing, that one required, I believe, was 110% of whatever the letter of credit was for to be backed inside of a CD. So we've seen the banks become very, very conservative. Part of that is also a regulatory framework. There's been layers and layers and layers of regulation, even since 2008, put on these banks. There had been some non-bank lenders, like you mentioned, WTI and some other groups that became very, very large and helping in the space. And even that group has just really had some pressure, I think mostly due to portfolio but due to lack of return and liquidity from equity positions they were taking in these companies as well. And you're right, for cost, often they come with warrants as well. So it's not just the debt. You're right, the debt covenants can be more critical to pay attention to in the deal terms. But most of those non-bank lenders required warrants. And honestly, even the banks do sometimes.
So, at least I've been reading a lot over the last couple of years about this massive growth of, quote, private credit. Is that not available for early stage companies? Is that the later stage companies? Are you seeing availability?
I mean, I know very little about debt. I do know that Franklin Templeton has a private credit group that we bought called Benefit Street Partners, and we showed them one deal in our portfolio, and they started asking questions like, "Where's the profit?" So we didn't show them any more deals. We like our companies growing extremely fast, such that they have amazing LTV to CAC ratios, so that it is economically accretive to go spend as much money as you can growing your business. And lenders tend to not like the idea of burning cash and lighting it on fire out in the backyard. And if you think having a VC might be a pain in the rear on your board, wait till you have a lender who's upset at you.
Well, I think we only have about 5 minutes left. But I want to wrap up the 5 minutes by really digging in a little bit more, Delilah, on this really interesting TSX venture. Because you're right. You know, when I started practicing law, which I don't want to say how long ago it was because it was a long time ago, we were able to do small IPOs. You know, even sub $10 million IPOs were being done in the U.S. As you pointed out, those are just gone. So why is that still available up in Canada? And for purposes of folks in the audience, if they're interested in learning more about that, how do they go about learning how they can potentially raise money on that market?
Yeah, well, the biggest difference between the Canadian and the U.S. markets is that the U.S. has a lot of big money, big family offices, big hedge funds, et cetera, private money. In Canada, we've never had that kind of big private capital. So we've always, for 170 years, have had to use the public markets to fund our very early stage. I mean, think about mining. It's like two guys and a pickaxe and a piece of land, and those companies go public in Canada, and they have for 170 years. So there's an infrastructure in Canada that's conducive to small public companies. So whether that's the exchange and how we have right-sized corporate governance, the securities commissions, the investors, we have a significant retail investor base in Canada that are, again, interested in getting on these 50-cent AI or mining or crypto companies, so that it goes to 5, 10. You don't get that on NASDAQ as a retail investor. So there's a marketplace specifically for very small public companies. And I'll just say for U.S. companies, again, it's your high growth, you're raising 5 to 20 million, you're looking for an alternative to private venture capital, you want to maintain greater control. When you go public, the cap table is flattened, right? So there are no pref share guys in your cap table. And you're interested in playing the public market game because you genuinely want to build a real business that's going to be on NASDAQ in 5 or 6 years. So if that is you, certainly talk to me afterwards. I actually have an event coming up in San Diego in April. So I'm looking for a few really great companies that want to explore this as an option. And again, my whole thing, and I've advised companies from bootstrapping all the way up to IPO. I run a global accelerator for female founders raising venture capital. It is that you just need to know all your options. And this path that is, glamorized in the U.S. of angel to VC to being magically acquired, it just doesn't happen for most companies. So just know all of your options. And we are one. You have to have a reason to be a public company. You have to go be ready, meet our requirements. Can your deal get done today? What's the reality? So if you're looking to explore that, then I'm happy to talk to you.
Fantastic. Well, look, I think this was really interesting. We heard a lot of different perspectives, lots of different markets to go raise money. So hopefully you all came away with some new ideas of where to go to raise money for your company. I want to thank all of you for the great preparation and really great information. Thanks for being here.